So, with over more than 25 years of experience across various sectors in management consulting, audit and assurance, taxation, and corporate finance, and with more than 75 professionals in our team, in our organizations, we boast 90% client retention. So we have four business verticals. First is management consulting, which helps an organization to create a new process, or if any existing process is available, we help to improve the process. And once a process is set up and is in play, audit and assurance team helps an organization to checking whether the process is working properly and accurately. And we have a tax advisory team that helps you with statutory compliances like income tax filing, GST filing, etc. And we have corporate finance team that helps in all the finance aspects of an organization, including fundraising through debt and equity. So let's meet the speakers. First, Ratandeep ma'am, who is a partner of our of our organization, and Mr. Bharani Kumar, who is a team lead of corporate finance, and me, Aditya, who is a senior analyst in corporate finance. So now let's move into the topic. Today's topic is about fuel for growth. How the right funds at the right time can transform your business. So let's view the agenda for today's topic. So first is introduction, then we will see when is the right time to raise funds. Then we will see growth needs money, but what kind of money. We will also check what funders look before giving you money, and we will see conclusion and a Q&A. We will also have a Q&A session at the last. So first, before introducing, I would like to impart you on the importance of having the right funds at the right time for a business by giving an example of how growing a plant. So, for example, I think so. Everyone in the who is attending the webinar would have grown at least one plant or one tree in their life. So, when growing a plant, you will first till the soil and sow the seed, and among other things, you will pour the right amount of water at the right time so that the plant can grow from a sapling to a tree. So just saying the right amount of water at the right time will not be enough. So you putting more, because if you put more water means the soil, the plant will become rotten, and it won't be able to grow into a proper healthy tree. And not putting the right water at the right time will enable will help, will not provide the right nutrition for the plant, and its roots will be weak, so that the plant will also become so weak. So providing the right amount of water at the right time will help the plant to grow into a healthy tree. Just like that, in case of a business, getting right funds or the right amount of money at the right time will help an organization to grow into a big enterprise. So just saying like, okay, think of growing and or getting right funds at the right time by using the metaphor of a plant will not be enough. So I would like you to stress this importance with a real life example. We have an retail textile player who grew from one store to two store in 10 years. Then he understood the importance of having right funds at the right time, and with our help he was able to grow from two stores to three stores in 3 to 4 years. And in the as we are taking this webinar, he is now opening his fourth store within a year. So this getting right funds at the right time not only enabled him to grow at a faster pace, but also ensured that his existing stores does not hamper his growth. That is, the growth in his existing stores did not get affected due to putting focus or opening a new stores. So this is the main critical thing that we get from getting right funds at the right time and utilizing it. So before going into the need of funds, I will generate a poll, and I would like you to give the answers to the poll. So let's see the poll now. So in this poll, we would like when we are asking when did you raise funds. So we have five options like buying. You would have raised funds. Everyone would have raised funds. So I would like you to choose from any of the five options which options you did raise funds from for the purpose of raising funds. Okay, so as we have seen, many of you said that we are raising funds for buying a new loan, 50% of you. Then some people were getting funds for to construct a new building, and some people were raising loans for buying stocks for the upcoming season. So as we have seen in the poll, there are various situations that say that says that you need to raise funds. So we will see three common situations that will help you to understand that says you should raise funds. The first need is that opening a new store. So as everyone knows, opening a new store will always require you to raise the funds. Next is upgrading machinery. In the case of manufacturer or service industry person, everyone will use some kind of machinery. Once the machinery becomes obsolete or once its shelf life is over, you either need to repair the machine, do major repairs on the machinery, or you would require to replace the machinery. Both these things will cost more and it would require you to raise funds. Next is keeping seasonal inventory. So this text retailer will be easily able to understand, particularly in the case of those businesses that are seasonal in nature. For example, textile. So in case of a textile retailer in India, they will have two main seasonal sales, that is Diwali and Pongal. So during these seasons, there will be a huge demand for their inventory, and therefore they would require to stock up on these inventories 2 to 3 months before. In order to stock up on those inventories, they would require funding which they will not be able to get on the off season sales. So these are some of the common situation that says that organization is in need of funds. Now let's see when is the right time to raise funds. I will also help you in understand. I will help you with this and understanding this using the same example. So as planting a tree. So for example, in case of planting a tree, you will pour water. So when you think of pouring the water, you will first see the soil. First, we when we see the soil, it will either be dry or it will either be mushy or watery. So if it is dry means it says that the soil needs water and you will pour water. If it is mushy or watery, then you know that there is enough water in the soil and you should wait before pouring the water. In both the cases, you will see signs that says you should water the plant, and signs that says you should wait before watering the plant. Similarly, in case of raising funds, you should see signs that says you should raise funds and signs that says you should wait before raising the funds. So there are various signs in both these cases which will be unique and different for each and every organization, and we can't speak each and every sign in this. So we will be talking about three major signs in both the cases. So in the first cases, first sign is losing customers due to low stock or capacity. Here the owner will think we are getting more orders, but we don't have enough stock or people to serve them. In this case, you can either go for a working capital loan or a short term loan to build your inventory and or hire staff, so that you don't lose your customers. So the second case is a new opportunity comes, but you can't afford it. So in this case, the owners will generally think there is a great shop available next door, but I don't have enough money to take it. So if you want to let's just say you want to open a new store in XYZ place, because you have made some you know that if I open there I would get good sales, but you also know that there is a great shop available, but you don't have enough funds to buy the same. In this case, you can go for an expansion capital, that is either debt or equity, depending upon the scale and depending upon your requirement. Next is you are profitable but always struggling with cash flows. So here the owner will tell that I sell well and I have enough profits, but my cash flow is getting always stuck with customers and suppliers. So the important thing to note in this point is that it is not only enough to generate adequate profits, but an organization also needs to generate adequate cash flows in order to sustain. So the importance of cash flow management is very crucial in case of retail businesses. We already took a session on cash flow management that says why it is important, and I would like people to who are watching this webinar to watch those session which is available in our official YouTube channel, and which we will also be posting this link of the same in the chat to understand the importance of cash flow in a better manner. In this case, the funding need will be you can take a working capital funding or a bill discounting funding based on your requirements, so that you can manage your cash flows. Now let's see some signs that says you should wait before getting the funds. So the first sign that says is that you don't have a clear plan for how you will use the money. So here the owner will tell you, I know I need money, but I'm not exactly sure how much or for what purpose I need the funds. So why you should wait before in this case is that before raising any funds, if you don't have any clear purpose, it will lead to poor investment and poor return on investment. And generally, lenders and investors would hesitate in when the person who is receiving the funds does not have a clear plan on how we will use the money. So you have to wait until you have identified a specific goal, that is buying this XYZ machinery or hiring this particular staff or team, and you should have a clear budget on how you will repay the loan or give exit to the investor. So the next thing is you have your cash flows can't support your repayments. That is, we can repay when sales are good, but some months are tight. This situation is particularly can be understood for a seasonal business that we had explained before. So in case of a seasonal business, there will be some on-season sales and some off-season sales. We will have huge on-season sales, which will enable us to pay both creditors and loan, and we will also might have some surplus. But in the case of off-season sales, there might not be enough funds to in sometimes there might not be enough funds to pay your creditors or you pay your debt. So you would be in a situation where you would think I need to you have to decide whether you should pay your creditors or you should pay the debt. Why you should wait is your in cash inflows are unpredictable, and taking a loan or funding in this stage will only lead to a debt risk. You can wait until your revenues become more stable, or you can go for some equity based option or flexible funding options, or else you can also wait until you have a clear you can put a clear plan and budget, that in case of on season if I get extra money, I will be able to save that money and I will be able to repay both creditors and my loan obligations in the off season. So off season. So now we have seen some signs that says you should raise funds and some signs that says you should wait. So now we will see a 3 question checklist that everyone can use before you can raise the money. So the first question is that you can ask is, what is the purpose of raising the funds? So as we have seen earlier, the people generally won't give any funding to the person until they are until they are confident that the person has a answer on what purpose he is raising and what where he is going to use the money. So next is, what is the expected return from using the money? Just because I know the purpose for raising the funds and I am using the funds for that purpose, it doesn't mean that it will generate profits. It will only generate profits only when I am able to earn a return on investment that is higher than the cost that I am incurring in raising the funds. So the last thing is, how will I repay the loan or give an exit to the investor? So whoever who gives you either the lender or an investor that gives you funds will only give you based on the notion that you will repay the loan or you will give me an exit, that is I will receive back my money with an additional interest or an additional profit. So you should have a clear plan that states that I will be able to repay the loan with this money, or I will be able to give an exit to the investor based on this reason. So we have seen these questionnaire checklist. If a person is able to have a clear answer on these 3 questionnaire checklist, then they can say that they are ready to raise the funds. Now we will see growth needs money, but what kind of money? So there are typically various types of funds that are funding options that are available in the market, but everything can be broadly classified into 3 types. They are, first is internal funds. So internal funds are generally the funds that are generated by ourselves. That is putting our own capital into the business in the case of proprietorship or partnership, or generating profits once the business started earning. We will be able to generate some profits that we will reinvest into the business in the form of retained earnings. Both these types of funds can be classified as internal funds. These funds are these funds are beneficial at the start of the organization. Now we will move to loan funds. Loan funds are typically borrowed funds that we get from an banks or financial institutions for an interest. So the last is equity funds. Equity funds can easily be seen as funding in the form of a capital, but not by us, but from an outside party. So till now we have seen why it is important for organization to understand the topic of raising the right amount of funds at the right time. We also saw some signs that says you should raise funds and signs that says you should wait. We also saw a 3 questionnaire checklist that will help an entrepreneur to know his readiness for raising the funds. And we also saw a brief introduction on the top three, on the brief category of funds that are available in the market. Now I'm handing over to Mr. Barani, who will give you a detailed explanation on the loan funds. Thank you.
Yeah, thanks, Aditya, for your presentation on how the right funds at right time could help a business to transform into the path of profit and growth trajectory. And talking point in today's webinar is certainly interesting because it's not only businesses that needs money to manage its operation. Even individuals like each of us do need funds for various purposes in the course of life. But their difference, there lies a difference. When in case of individual borrowing money from banks or financial institutions, it is to accomplish their personal needs and comforts. Whereas when a business entity borrows money from banks and financial institutions, the purpose will be different of individual because they are going to invest in business to earn profits and growth. So here lies the difference between the funds forwarded by the business and the individuals. So now let's understand debt finance. Debt fund or debt finance refers to money. Generally, money doesn't come for free and it carries a value called interest. And generally, we interpret money in different ways. We call it savings when we own it, and when we have an excess, we lend it to banks as deposits and earn interest. And same way, we can invest on various wealth management products like shares, debentures, bonds, and securities, where we earn profit out of that investment. Whereas when individuals or businesses goes to borrow money from the banking institutions, we need to repay it with interest, and as per the agreed terms with the banks. So generally, in simple terms, if at all we wanted to understand what debt fund is all about, it's the borrowed funds from a lender, usually a bank or financial institution, and that has to be repaid with interest over a defined period. Whereas the debt fund term is purely a financial term, but it purely represents the funds borrowed from banks. So now let's look at how the funds borrowed from banks differ to an individual and business again. Uh, because of today's webinar mainly focuses on debt funds for the businesses. To start a business, you need some funds, and to run a business, you need some funds. So these are the two types of funds a business should own it. So we classify those two needs of funds as term loans and working capital. So let's say, for example, if I wanted to start a store or a textile store, definitely I need a building for it, right? And I need some interiors to be worked upon. I need some furnitures to receive the clients, and I have to make other arrangements like electricity, air conditioning, and I have need some stock to kickstart my businesses. So to set up a business, we need some funds, and those utility of funds is what we call it as term loans. And after setting up a business, definitely we have to run a business, and where we incur a lot other recurring expenditures like electricity, and we have to pay salaries to the employees, and we have to pay for the logistics. So to maintain the daily routine of the business, we need some funds, is what we call it as working capital. So this working capital comprises of two facilities. One is overdraft and cash credit. So cash credit here refers to funds that are given by a bank to support a business, and this is a short term in nature. It's a long, not a long term, because if you look at term loan, by the very word, it's term. So there's a definite repayment period which can run from 3 to 10 years or 5 to 15 years. Whereas in case of working capital, overdraft or cash credit, these are short-term obligations or short-term loans provided to the business to run their daily operations smoothly and to meet their short-term obligations on a daily basis, be it operational or financial in nature. So overdraft is a facility that's linked to the current account of the business, and based on the credit worthiness and based on the financial strength of the client, a pre-approved limit is given on the account so that the business will be able to utilize the funds within the given approved limit. And whenever he is making cash accruals, he'll be able to repay, and he'll be utilizing the funds in a revolving line. Yeah, so that is what is all about overdraft, and cash credit is something which is and same again running facility given to the business entities based on the strength of the stock value and receivables. So the business will be using the funds within the approved limit or the drawing power which is given based on the stock to run the businesses and meet their daily payments to the creditors and other invoices and logistics kind of. So these are the two types of funds a business needs. One is the term loan, the other one is the working capital, which are the primary type of debt funds that a business needs, right? So now we'll look into in detail of the working capital loan and the term loan, and we have government schemes promoted by government of India supporting small and micro enterprises, because the government wants to a large population to involve in business activity for the growth of the country. So now let's look into the various purposes for which a working capital is loan. It's not only for routine purposes. There are several other purposes. Let's look in detail of it. So yeah, term loan and loan against property. And there is one more product called loan against property. And by the very term, we can understand that this loan is provided against the strength of your collateral. So collateral here is nothing but your tangible assets. It could be of building, land and buildings, and it could be of commercial in nature, or it could be a residential, or it could be industrial. Because when the business starts their start when the business begin their business, they start creating fixed assets, and over a period of time, the value of the land and building do appreciates, and at one point in time, it is helpful for the business back again to encash the appreciation by revaluation of those fixed assets. So in that way, loan against property helps them. So this is also a sort of term loan where the tenor could vary from 5 to 15 years, and there are various other purposes for which these term loan and loan against property could be put to use by the business entities. Let's go through one by one. For purchase of machinery and equipment to improve the production capacity and efficiency, and this debt fund of term loan and loan against property can be utilized for acquisition of land and building, as we earlier discussed, for setting up factories, warehouses, or office premises. And it could be utilized for construction of industrial sheds, for setting up manufacturing and processing units. And it could be also for purchase of commercial vehicles for meeting the logistics, transportation, and the delivery operations of supply chain needs. And it could be invested in technology and upgradation, so like investing in ERP systems, servers, and automation tools. And also it could be invested in product development and research and R&D for innovation, building prototype and product enhancements, etc. And one other purpose which these two funds, term loan and loan against property, can be put to use is for business expansion. So we can go in for opening up new branches or expanding the existing operations, or we can enter into new markets, kind of purposes which these term loans are useful. And also sometimes a business can acquire and buy out a competitor company which is in the same line of business. And mostly the one among the primary purposes for which the term loan and the loan against property is useful for the business entities are to debt restructuring and refinancing. Say, for example, the business can use to replace the high cost short-term loans with structured long-term loans, because so it will help the business to come get out of unsecured loans, and it will help them to use the bank's long-term structured loans, so that some cash accruals are available with the business. And also it could be put to use for GST, taxes, and other statutory payments. So we can, if at all there are any pending or dues to be paid to the regulatory authorities, we can use these funds to clear your tax liabilities. So these are the various purposes for which the term loan and loan against property are put to use by business entities, and it's of very useful for them to grow and build their profits and business. So next we'll discuss on working capital loan. As we have earlier discussed, a business would need two types of funds. One to set up for term, we need term loan or loan against property, and another is to run the business, generate products and services, and generate sales and earn profits. For that, we need working capital loan. So let's look into what are the other purposes this working capital loan can be put to use by business entities. And it could be for purchase of raw materials, to maintain adequate inventory for production and sales, and it could be for payment of wages and salaries to ensure timely payment of employees, and it could be for logistics and transportation to meet supply chain and distribution costs. And this working capital loan could be used for inventory management, to stock finished and semi-finished goods for sales cycles, and it could be used for maintenance expenses like annual maintenance, small repairs, equipment servicing, etc. And it could be utilized for payment of vendors and suppliers, so that it helps us to prevent from credit defaults, and helps in better credit negotiation with the suppliers to strike out deal discounts. And it could also be used for utilities and overheads like rent, electricity, water, fuel, and office supplies, which are routine in nature for any kind of business. And this working capital loan could largely help to bridge the credit delays when our clients delay making payments to us. So these funds will be helpful to bridge that gap. And it could also be used for purchase of raw materials, because maintaining adequate inventory for production and sales is very important for any business to meet the seasonal demands. And let's move on to there are a lot of numerous government sponsored schemes that are available for the businesses, but in specific, we'll discuss on CGTMSE. This loan is sponsored by government for to enable and encourage micro and small businesses. And they provide up to 5 crores as term loan and working capital and without any collateral. And the government also provides 75 to 80% guarantee on the loan amount. And the types of entities would be eligible as proprietorship, partnership firms, LLPs, private limited companies, and one-person companies could avail this benefit, so that the government wanted to encourage people, a larger population, to involve in business activity to generate GDP for the country, as well as employment opportunities for in the country, rather depending upon government opportunities. So this CGT MSME has gained quick attention and contribution by the small and micro enterprises. So from here we come to the end of understanding what debt fund is all about, right? And what are the types of debt funds mainly used by business entities? As we have discussed, term loan is there, and loan against property, and capital loan, working capital loan. Under that working capital loan, we have discussed on what is overdraft and cash credit. And we have seen CGT MSE as a government-sponsored scheme available for small and micro enterprises. And we'll just close up with a case study. What we understand in reality is because our country is mostly backed up by MSMEs, which are population of sole proprietor and partnerships. And since it's all new generation involved in the businesses, these small entities fail to maintain a proper financial discipline and books of accounts. So what they feel is if we get fund from the banks, it could be utilized for any purpose. But that is not the case, because the banks, when lend loan money for the business purpose, they are very clear in what are the purposes the funds has to be put into, because it will be properly classified as whether it's a term loan or working capital loan, and what are the purpose we discussed under working capital loan. Only for those purposes the funds has to be utilized as per the as per the bank's agreement terms. But businesses fail to do that, so they feel that they can use short-term funds like working capital, overdraft, or cash credit to buy or to invest in real estate, or they invest in share market, so that they feel that we can quickly make some money and we'll be able to again fill the gaps. But that is not the case, and in most of the cases the businesses fails, because when they utilize the short-term funds on the long-term purposes, say for example they have purchased a land out of working capital loan, so now they are unable to meet their creditor payments. Now they are unable to meet the obligation to the banks by paying interest, servicing the interest, and they are not able to purchase raw materials, so that the production also comes to an halt. So these kinds of problems the businesses are facing. So let's quickly go through the case study, so that we'll be understand how difficult or how the business gets into financial stress and finally collapses due to mismanagement of short funds on the long-term purposes. So here, for we have TechCraft as a business name, and it's a sole proprietorship. Before going for a working capital loan, let's look into their profile. They are in a solid business model, supplying electrical goods and contractors and retailers, and they have a working capital limit of up to 50 lakhs from a bank, and their monthly turnovers seems to be around 25 to 30 lakh, with credit sales of 30 to 60 days cycles and decent cycle, and inventory turnover of 45 days, right? So this is the profile before going for loan. But what they do is, once they avail the working capital loan, the business owner decides to invest on plant and machinery, which is a term loan component, because it's of long term in nature. So he is putting the short term funds into machinery for a cost of 40 lakh rupees, thinking that he'll be able to quickly start production, and he'll be able to make the sales, and he'll be able to achieve the profits and invest and meet the banking requirements. But what happens is the new line takes 6 months to operationalize, and for this during this period of 6 months, the suppliers' payments are delayed, and because of that, default on loan servicing, and due to this, sales are affected, and because of this, the credit score got impacted, and so he gets into all the difficulties. All the difficulties. Uh, yeah. Okay, so now due to the misutilization of short funds for long-term funds, the business monthly sales have fallen from 2 crores to 1.5 crores, and the CC utilization percentage falls from 60 to 100% with overdues, and inventory replacement was smooth earlier. Now it got frequently delayed, and credit days of 45, now it becomes 75 to 90 days, and the bank status is standard. Now it has become non-performing, and the recovery measures the bank has initiated a legal notice. So now we understood how misutilization of a short fund for a long-term purpose will end up in financial stress and closure of business. So with this, we come to the end of discussion under debt funding. And now I will hand over the session to Mrs. Ratandeep. So to discuss in detail on equity funding.
Yeah. So, hi everybody, happy evening. Thank you, Aditya. Thank you, Varni, for beautifully consolidating how things are, how a business can be grown. So, from a sapling to a plant to a tree, and let's see how this can be a magnitude of a jungle or a forest altogether. So, to do that, no, there's something called as an equity funding. Okay, because let's say the primary difference between a loan funding and an equity funding is in loan funding, there is an obligation. There is an obligation to repay on account of, let's say, a standard monthly principal commitment, or let's say it's a EMI based commitment, or it's a ballooning commitment, some kind of commitment which is very, pattern oriented. But while in equity, there is no commitment to repay immediately. There is a commitment to provide an exit. Is there a collateral involved in equity? No, there is a collateral involved in loans. But then how does it make a difference? To make a difference in equity, you give a part of your company as a share to the investors. So it could be 5% stake, it could be 10% stake. In loans, you still own or there is a control over the company completely. So this is the primary difference between the loan funding and the equity funding. Now let's see who all does equity funding. In this entire world, a lot of bankers, the non-banking financial companies, there were private lenders who lend the money. But there are a certain category of people who do equity funding. The first one is when you do a startup, you have in technology, you have a product that is innovative, and the friends and family come as a first support to make sure that you are moving ahead to try to develop a prototype. The second one is angel investments. Angel investments, it could be individuals, it could be a group of angel networks, anybody. I mean, somebody who has done that previously and would like to develop somebody else's business, coach business, or that's called an angel investor. The third one is a venture capital on a private equity fund. Venture capital, they are very large in size. In the sense, they have a very proper protocol, process-oriented approach towards investing and monitoring the investment so that they can make returns out of the entire thing. And the fourth one is nothing but an SME IPO. So it is from the public that the company raises funds. It starts with friends and family, and ultimately the destination, if we have to give an exit to the angel investor, to the venture capital, or to the PE, it is through investments from the public in an IPO that they are able to give exits to different stakeholders or shareholders. In this journey of growth, right from the product development or innovation or app development or technology or software, whatever it could be, from here to making it scalable, to making it a global brand or a national brand on its own, different types of investors get involved, depending on the stage. So just let's elaborate each of them. Let's move ahead and elaborate each of them. First is friends and family. So your go-to people who trust you without knowing whether you will be able to execute or not is your friends and family. Small amounts, not a very large capital pool, but still small amounts, helps you to test whether your product or innovation will work forward. There's no pressure from friends and family as of tomorrow you are going to repay, 3 years later you're going to repay. It's basically on the trust that you will be able to do a better job with that capital than they are currently doing. They will give you this money. The only challenge is if you're not able to repay this money, your personal relationship might get strained here because obviously money is an important factor. This is a very small pool of capital, but it is enough for you to start with. Okay, I mean, to get onto the board, to create a product that can be marketable. I'm just saying the stage at which it comes in. Yep, the next one. Next one is angel network. These are all professional people. Either they have done business earlier and then they want to invest in people who are doing new businesses, new age businesses, technology oriented businesses, or they are like, CS, CEOs, CFOs, CXOs who have that pool of money and they want to invest, or they are passionate about investing in the industry that they have seen or operated upon. So what they do is they invest, they collectively, it could be an angel network also, like Chennai Angels, Mumbai Angels. They collectively raise capital from their members and invest in a business so that the business can go from 0 to 1, which means a product market fit is there. There is a little bit traction on sales. So they're like, yeah, okay, this is able to do sales. These have the unit economics in place. Let's move ahead and see how, if we invest, the company can grow further. Sometimes these people also give mentorship. Most of the angel network also have a, say, basically they have a lead investor in the entire thing, and that person also offers mentorship and contacts, networks, whatever he brings on the table along with the money. The challenge is that obviously in any kind of investor relationship challenge, it is more of how you get that relationship right. If you're able to get this relationship right, it works wonders. And if not, it can make or break, I mean, it can make or break the journey altogether. And the next one in the entire thing is, recently we heard some unicorns just pay. We have already heard Porter has become a unicorn now recently. So, how do these companies become unicorns? Basically, if you look at it, is somebody would have invested in stage one, it has moved to stage two. The company has grown at least 20% or 30% year on year, okay? And then when it moves to stage three, this 30% now it can grow. Now it has become a decent size where customers are accepting the product, the price. They're able to service the customer. There is a team that is servicing the customer. They are able to do branding, marketing. So almost things are in place, but it is just that the size and the scale is smaller. Now, if you have to expand rapidly, grow rapidly, then you need large chunk of money here. That is when the venture capital or the PE funds come in play. So anywhere from 10 crores and above 200 or 200 crores of venture capital, and a PE firm will start with 50 crores to 75 crores and upwards, okay, up to 500, 700 crores also. So that's how this Ola, this Paytm, and everybody has, raised hundreds of crores gradually. Okay, this also takes time. They also have an exit pressure. Okay, all the venture capital and the PE firms have severe exit pressure from the limited partners who invest in them, which could be 5 years, 7 years, and they have a very disciplined protocol beyond which they do not extend in the investment. So either they have to exit or making money or not making money here. That's why they're demanding. Okay, that's why they are also sit on the board. That's why they take decisions along with you so that you do not fail in the entire journey. All happening, we find few nuggets, few diamonds, few, stories are spoken about a lot, and there are many stories which are not spoken about. Overall, if you see, but this is how this entire world of venture capital and PE funds is. A lot of money will chase the entrepreneur. The growth has to be multiplied. At least I'm saying 20% year on year on a revenue level. And so the profitability and henceforth. The next one is the SME IPO. In SME IPO, you raise money, the company raise money from the public. Okay, earlier we had only main board IPO, 10 years, 2014, 15. They opened up this entire thing for small and medium scale enterprises, somewhere between a 5 crore or 10 crore turnover to upwards of 700, 600, 700 crore turnover. They all come under the seven small and medium scale enterprises, and they can raise funds from public. Earlier it was not there. Earlier it's like 250, 500 crore, 250 crore and above only you can go for main board IPO. But now this SMA platform is especially for businesses which has a legacy, which wants to scale up, which has proven its market potential, and it is looking for funds from the public. The advantage here is, like how a lot of control is with you, since this capital is raised from public at large, not an individual private investor. There's a lot of control in the promoter's hands. Though there are stringent reporting mechanism, compliances are very stringent, SEBI is getting involved, NSE is getting involved, all the records, all the practices of a main board IPO is almost followed in an SME IPO. Then there is a lot of flexibility. There's a lot of room for an entrepreneur to make wealth. Basically, if you're still with a private person, you are seeing the valuation, but you're not able to encash the valuation. But when you get listed, you will be able to encash the valuation because there will be public who will be willing to buy your shares in parts. So that makes it a lot more liquid investment, both for the public as well as for the entrepreneur. I mean, getting listed is the final destination any business should be aiming for. And once that happens, there's a different structure and a different growth altogether. So we've seen different types of equity funding, how these each of these equity funding play, at what stages these equity fundings have a role to play at. Now let's look at the next thing. What do funders look before giving you money? See, funders can be lenders as well as investors. Anybody, okay? Like Aditya says that there are three questions that you should answer. What is the purpose of funding? What is the return you are going to make out of the money, which means where you're going to deploy and how you're going to make the return and how you're going to give an exit. Similarly, if a company has to be validated by an investor that it is an investable business, I'm saying, yeah, I want to invest in your business, then they look for one, a business model, which means how my business will function, who are my end customers, how I'm going to reach them, whom I'm going to procure it from, what is the product that I'm going to sell, what is the distribution channel, what is the margin, what is the revenue, what is the cost structure. Everything will be thoroughly analyzed by them as they see a value. So we do generally do a business model canvas for a business to help an investor explain that this is how we are operating. We have actually taken a session on business model canvas also. We will be sharing the link here in the chat box. Maybe you can review that also. So that gives a clear cut picture of where this business is and how it is heading towards. The second aspect is I understand the business model. So let us say the business model is a payment gateway, something like a Paytm. Okay, it helps people make the payment faster. It helps people to identify or to encash on the offers. It helps people to make it is more convenient. So something like convenience is what you're providing. How you can multiply this? So I need to invest in technology so that I can be faster. I need to invest on people so that it can reach more. I can have a robust system. There can be a cyber security check always. People will not be defrauded. So how are these systems going to be put in place? What is the purpose of taking the fund and how it is going to be utilized? This is what is the next thing that an investor is looking forward for. And the third thing, what has been my past performance? What kind of sales? What kind of track record? What kind of compliances I have been through? Which means even if I'm a private limited company, what is the compliance from the Companies Act perspective, Income Tax Act perspective, Employees Act perspective? So all those things, am I compliant? As is the company compliant? Once it all this gets established, let's say past performance is there, then whether what I am saying and what is happening in the company is correct, which means a trust factor. The next factor is a transparency and trust factor. Aditya, can you just, yeah. So here, let's say I say that this company has been through this. This is the challenges. This is what we are capable of. They will do a due diligence. They will understand what you're saying to them orally and what is happening in the company is almost on page. At 80% also, if it is on the same lines, then they will trust you and they will invest in you. But if there is a difference here, let's say, we are not able to establish what you have said, then it gets broken, the deal is not done. I'm giving you both the things that what helps them build that trust. So you'll have to commit by whatever numbers you have shared with them, and when they do a due diligence, they should find the same stuff. This establishes trust there. And once trust is established, the deal is much more easier. After this, there is nothing but, valuation, deal, term sheets, and all those things. But overall, if you look at it, these are the four factors that the investors or the funders look into. From the company's perspective, if you look at it, it is simple. You also have to find the right growth partner for you. Then how do you help that? So we at Consulting and Beyond, we will first understand your business. We'll understand the needs of your business, how it can fit in, where you are, how it fits in. The second step, Aditya, can you just scroll, take the screen forward? Yep. Identifying the right person for the growth. What is the stage you are in? If you need debt or you need equity, what is your plan? Are you ready for the entire thing? We will do a funding fit analysis also. So we will understand from your business what kind of funding is required, where you are, what stage of growth you are, what is the funding that we can do, and the next step is we will prepare you. If you're looking at equity, then what kind of, records, data room that needs to be built. If you're looking for debt, then what kind of collateral, what kind of structure needs to be fit in? Can we look at government funding? So we will prepare you for all the types of funding that we are saying that this is possible. Once you're prepared, once you know what your purpose of the entire funding is, we will connect you to the right people, lenders or investors, and get you the funds. This is how we play a role in entire funding part. Now, this is very critical. We can say it is very easy because in today's world, if you see more than 29 banks and non-banking finance companies are operating in India itself, and this world is expanding. Slowly, all this payment gateways, everybody will get the license, or what do you say, the license to do small ticket funding, microfinancing, or maybe a large ticket funding also. Small banks are evolving and making themselves into large banks. So though this entire space is filled with a lot of options, but what would fit your business will make a lot of difference to the way you will handle the business from here on. And that's where consulting and beyond plays a major role. If you get the right kind of funding, everything in your business is getting set. Your balance sheet will get set. Your growth trajectory will not be hindered. The way you want to place yourself in the market, that will also not get hindered. So this is the I would rather say put ourselves in a different position altogether to help you grow, to help the companies grow. So recently we raised a fund for a Tanjore based textile store at 10 crore funding, and it was almost done in a month's time. That helps them to bring their creditor days by another 30 days from where they were. And next one was a battery manufacturer. Literally, we are preparing them for the next stage of equity funding, which means where they are, what kind of product market fit, and marketing and expansion plan, and see how they play out for the next 6 months, and then work on their equity funding. And the third one was a Villapuram-based client for whom we have raised almost 63 crores for their jewelry showroom, which includes a working capital and a term loan. In fact, it has become a one of a showroom of its kind with the kind of variety that it is offering. So it adds strength when you have that support of funding to move forward and make that bold moves and bring to the market something new which has not been existing earlier. So this has been our track record. Just to conclude this session, there are a lot of options for people who want to grow. Equity, debt, internal funds, private lenders, public lenders, limited companies, SME, IPOs. There are multiple options. To choose the right funding is one art. The second part is the timing. Is it the correct time to get into this kind of funding? A little earlier, you will have more funds, no big plans. A little later, you've already executed some plans, you're struggling with, making the execution work, and you have the pressure of raising funds, which means you may not really go for the right business partner, or you may raise it at giving a larger equity stake. So the timing is important, the type of fund is important, and overall, your growth plan should synchronize with that entire lender and investor. So this is what we have to offer, and we are looking forward. Consulting and Beyond always looks forward for where their client can grow, and we understand that funding is the fuel for growth. At this stage, wherever your business is, if you can just fill the form that is put in the chat, we will understand and we will see how we can help you grow forward. Thank you all. Thank you for the wonderful participation, and we are open to Q&A.